Welcome back to Mind Over Markets. If you are new here, this channel exists for one reason: to give you the mental and strategic tools that the trading industry does not want you to have, because your losses are someone else's profits. Today we are going deep on a complete, structured, battle-tested survival system. This is the difference between traders who are still active 3 years from now and the ones who blow up their accounts and disappear before the year is even over. And stay with me for every minute of this, because what I am about to share is not theory. It is the difference between building real long-term wealth and becoming another statistic. Let me start with something uncomfortable. According to data consistently published across financial studies and broker reports, somewhere between 70 and 90% of retail traders lose money. What I want you to notice is not the number itself. It is the word retail, because professional traders, people running systematic, disciplined, rules-based approaches do not have those numbers. And the question worth spending your entire trading career answering is, what is the actual difference between those two groups? The answer is not intelligence. I know retail traders who are genuinely brilliant, engineers, doctors, lawyers, who still blow up. I also know traders with average academic backgrounds who are quietly, consistently, almost boringly profitable year after year. The difference is not IQ. The difference is system. The difference is structure. And that structure has three pillars: your shield, your map, and your referee. This is the 3M framework. Part 1. Why most traders are climbing a mountain with no rope. Imagine standing at the base of a very tall mountain. The summit is real: financial freedom, time freedom, genuine wealth. People do reach it, but most people trying to climb show up with no map, no safety rope, and no mental preparation for the psychological toll of the climb. And they are doing all of this in the middle of a storm. The market is always storming. Volatility and uncertainty never go away. Yet people keep showing up completely unprepared and then wondering why they fell. This is the reality of trading for most people. They come in excited, fund their account, start clicking buttons, and for a while it goes okay. They might even make money early. And this is actually one of the most dangerous things that can happen to a new trader, because early success in trading can be worse than early failure. Early failure teaches caution. Early success teaches you that you know what you are doing, when in reality, you got lucky in a favorable environment and had no idea what was actually happening. Then the market shifts. The easy conditions disappear. A trade goes wrong. Because you have no system, no rules, no framework, you do not know what to do. So you improvise. You follow your gut. And emotion in trading is almost always catastrophic. You hold too long, you exit too early, you double down on a losing trade, you revenge trade, and then you are gone. You are part of the statistic. The traders who survive are not the ones who never make mistakes. Every trader makes mistakes. The traders who survive have built a system that limits the damage of mistakes and compounds the benefit of good decisions. And that system is the 3M framework. Part 2. M1. The shield. Money management. Your first M is money management, and think of it as your shield. Not a nice to have. Not something you will get to eventually. Your shield is the single most important thing that determines whether you survive long enough to actually become a good trader. Here is a truth most people in this industry do not say loudly enough. You cannot become a good trader if you blow up your account. The implication is profound. It means the primary objective, before profits, before strategy, before everything else, is to protect your capital so you are still in the game long enough to learn, develop skill, and eventually profit consistently. Think of trading capital like oxygen. Run out of oxygen and nothing else matters. The foundational rule of the shield is simple. Never risk more than 1 to 2% of your total account on any single trade. Let me show you why this is so powerful. Say you have an account of $10,000. At 1% risk per trade, you are risking $100 per position. Now here is something critical. Even the best trading systems in the world have losing streaks. Not bad systems. The best, most rigorously tested, most profitable systems still go through periods of consecutive losses. This is just how probability works in real life. So let us say you hit 10 losses in a row at 1% risk, yet you have lost approximately 10% of your account. You are at 90% of your original capital, bruised, frustrated, but absolutely still in the game. You can continue, you can recover. Now run the same scenario risking 10% per trade. 7 consecutive losses leaves you with less than half your account. And from that point, the math becomes brutal. If you lose half your account, you need a full 100% return just to break even. Not a great return. Plus 100% just to get back to where you started. The math of large losses is deeply asymmetric, and the shield is your protection against that asymmetry. The most common objection I hear to this approach: if I only risk 1% per trade, my gains will be tiny. How do I build real wealth this way? This objection is based on a misunderstanding of how compounding works. Take that $10,000 account. Say your system generates 5% return per month, a conservative number for a solid system. Compounded over a year, that is roughly 79% annual return. Over 3 years, your $10,000 has grown past $90,000. And the key word is over 3 years, because you did not blow up in year 1. You were still there in year 2 and year 3, and you were compounding the whole time. The trader who threw away the shield risked 10% per trade. He made some big wins early and blew up in month 4. That trader is not compounding anything. That trader is on forums explaining why trading does not work. There is also a psychological dimension to the shield that is just as important as the math. When you are risking an amount that frightens you, the emotional circuits in your brain activate. Fear and hope override logic and process. You exit trades too early because the paper loss is making you anxious. Well, you hold on to losers because the thought of taking a loss is psychologically devastating. You take trades that do not meet your criteria because you feel desperate to recover. All of these behaviors become dramatically less frequent when you are risking a small, non-threatening amount. When your shield is up, a loss is simply a cost of doing business. Defined, limited, absorbable. You can take it, learn from it, and move to the next trade with a clear head. This is not weakness. This is elite-level psychological discipline, and it is the foundation everything else is built on. One more piece of the shield that is often overlooked: your daily loss limit. Professional traders have hard rules on how much they can lose in a day before they are required to stop. Many set a daily limit of 2 to 3% of their account. If they hit that limit, the trading day is over. This rule exists because of tilt, the state of trading badly due to negative emotions, where you are no longer following your system but chasing your frustration. A daily stop-loss limit is your shield against tilt. It is the difference between one bad day and a catastrophic drawdown. Part 3. M2. The map. Methodology. Your second M is methodology. Your map. If the shield keeps you alive, the map tells you where to go. It is the difference between wandering through the market hoping to stumble onto a good trade and moving through it with intention and clear criteria. Here is something that might surprise you. The biggest enemy of a retail trader is not bad trades. It is too many trades. Professional traders talk constantly about the discipline of not trading, sitting on their hands for days or even weeks, waiting for a setup that genuinely meets all of their criteria. Most retail traders cannot do this because they have no map. Without one, every chart looks interesting. Every candle movement feels like an opportunity. You are in a constant state of low-grade FOMO, and this drives you to take trade after trade, most of which have no real edge. You are essentially paying costs over and over in a game where your entries are based on feelings rather than logic. Your map is a written document, literally written, not just in your head, that answers 4 non-negotiable questions before you click a single button. First, when do I enter? Not when the chart looks interesting. Not when your gut says it feels right. When do all of your specific objective criteria align simultaneously? Your criteria might include whether the trend is clearly established on a higher time frame, whether price is at a meaningful level that has been tested before, whether there is confirmation of momentum in the direction of your trade. The specific criteria matter less than the fact that they are specific and that you follow them consistently. Professional trading is not about having the perfect system. It is about having a consistent system that you execute with discipline. Second, where is my stop loss? Before you enter any trade, you must know exactly where you will exit if it goes against you. This is your invalidation point, the price level where the market is telling you clearly that your analysis was wrong. When you define your stop loss before you enter, you are making a rational, unemotional decision. When you try to make that decision while watching your position turn red in real time, you are making an emotional decision under duress. Those two decisions are rarely the same, and one costs far more than the other. Third, where is my take profit target? Professional traders define their exit before they enter, not after. The temptation to keep adjusting your target upward as a trade moves in your favor is overwhelming. The trade goes up 5% and you think maybe 10. It goes 10 and you think 20. Then it reverses sharply and you give back everything. This is not strategy. This is greed masquerading as strategy, and your map protects you by requiring you to commit to a target in advance. When you define both your stop loss and your target before entering, you can calculate your risk-to-reward ratio. If you are risking $50 to potentially make $150, your ratio is 1 to 3. And this is the fundamental question of whether a trade is worth taking at all. Professional traders will not take a position unless the potential reward is at least twice the potential risk. When you have no map, you never calculate this. You take trades where you risk 100 to make 20 and wonder why your account never grows even when you win more than you lose. Fourth, and this is the one that separates good traders from great ones. When do I do nothing? When is the right answer to walk away from the screen? Most traders never ask this deliberately. They assume the correct response to any moment in the market is to be doing something. But professional traders understand that roughly 80% of market activity is noise. Random, directionless movement with no reliable edge for any system. Your map must clearly define what conditions do not qualify, and when those conditions exist, you are not trading. This is harder than it sounds. If the market is open, your screen is right there. Your capital is just sitting. But here is the reality. The trades that do not meet your criteria are not opportunities for you. They are traps. Every time you take a trade that does not meet your map's criteria, you are not being proactive. You are breaking your own rules. And broken rules compound into broken systems and broken accounts. Part 4. M3. The referee mindset. Your third M is mindset. Your internal referee. This is where most trading education completely falls short, spending 95% of time on strategy and a paragraph on psychology. But here is what professional traders consistently report. For traders who have a working strategy with a genuine edge, the reason they underperform that edge is almost always psychological. The system works. The trader does not follow the system. The gap between those two things is what the referee closes. That your referee is your internal mechanism for staying honest, for catching the moments when you are about to make a decision driven by fear, greed, ego, boredom, or overconfidence rather than logic in your map. The referee does not judge you. It simply blows the whistle. It says, stop. Is this your system talking or your emotion talking? That single moment of self-awareness is often enough to prevent the catastrophic decision. Yet there are 4 psychological traps your referee exists to protect you from. These are not abstract concepts. They are specific, documented patterns of behavior that every trader experiences, and every one of them reliably loses money. The first is early exit. You have a trade open, it is moving in your favor, your target is still 30% away, but the paper profit looks real and the fear of losing it is overwhelming. So you close early. You take $80 instead of waiting for the $250 your map called for. Then you watch the trade continue to do exactly what your analysis predicted, hitting your target and going beyond, while you are on the sidelines having collected a fraction of what was available. Early exit is one of the primary reasons traders can be right more often than they are wrong and still lose money. That they cut winners short and let losers run. The exact opposite of what every professional framework teaches. The second trap is hope prison. Your trade has gone against you. You have reached your stop-loss level, the level your map defined in advance as the invalidation point. But instead of exiting, you move the stop-loss further away. You tell yourself the market will come back. Your potential loss grows. Hope prison is insidious because it does not feel like a mistake. It feels like patience, like conviction. But there is a critical difference between genuine reassessment based on new information and emotional refusal to accept being wrong. The referee knows the difference. Moving a stop-loss wider is not strategy. It is hope masquerading as strategy, and the market does not care about your hope. The third trap is revenge trading. You take a loss, something that feels almost physical happens in your brain, and you need to get that money back right now. And not through your system. Not by waiting for the next qualified setup. Right now, through aggression. So you take a trade that does not fully meet your criteria, or you size up to recover the loss faster. Revenge. Trading is perhaps the single most reliably money-losing behavior in this game. The market has no memory of your loss. It owes you nothing. It is completely indifferent to your emotional state. When you are in revenge mode, yet you are not trading the market, you are trading your frustration, and frustration is a terrible trading signal. The referee's response is straightforward. After a significant loss, close your charts and step away. Let the emotional charge dissipate before making any further decisions. The fourth trap is oversizing after wins. You have had a great week, 3 or 4 perfect trades all according to your map, and you feel on fire. Yeah, a new setup appears and you size up, double or triple your normal position, because surely this one will work too. The problem is twofold. First, no setup is certain. Your recent win streak has not changed the probability of the next trade. Second, when an oversized trade moves against you, the psychological damage is wildly disproportionate to the dollar amount, because it represents a deviation from your rules. And this psychological damage often triggers the other 3 traps, creating a cascade of bad decisions. The referee enforces consistent position sizing regardless of how confident you feel. The most powerful tool for building a strong referee is a trading journal. Not just a record of trades, but a psychological one. After every session, write honestly about what you did, what your system called for, whether they matched, and if they did not, why not? What were you feeling? What story were you telling yourself? That this kind of journaling creates self-awareness dramatically faster than unexamined experience. You start seeing your patterns. You notice you always exit early on certain days, or always oversize after a winning streak. Once you see your patterns, you can build specific rules to address them. Part 5. The 3 M's in action. The shield, the map, and the referee are not 3 separate tools. They are an integrated system, and each one makes the other stronger. Yet your shield makes it possible to follow your map calmly, because when you are risking a small, non-threatening amount, you do not need any single trade to win. You are not desperate. You can simply execute the process. But when your shield is down and you are risking too much, even the best map in the world gets corrupted by emotion. Your map makes it possible for your referee to work because your referee needs something to enforce. Without a map, the referee has nothing to compare your behavior against. It is like a referee showing up with no rule book. Your map is the rule book. Your referee enforces it, and your referee makes it possible for your shield to work, because your shield only protects you if you actually follow it. The rules are simple. Following them in the heat of a volatile market, but when everything in you is screaming to double your size because you're certain about this one, that requires the referee to be awake and on duty. Here is what this looks like in practice. A major piece of news hits and a stock moves sharply. Social media is on fire. FOMO is palpable. Without the 3M system, you jump in. You do not know where you are entering relative to any meaningful level. You have not defined a stop loss or a target. You just bought it because it feels like it is going up and you do not want to be left behind. Then it reverses hard, because price had already moved significantly and you bought at the emotional top. The smart money sold to you at the peak. Now you are watching your position lose money with no plan, and every second the loss gets worse. With the 3M system, the moment you feel that FOMO surge, your referee immediately blows the whistle. That feeling is a warning sign, not a signal. Your map tells you to check the checklist. Is price at a meaningful level? Is the risk to reward acceptable? In a sharp emotional spike, the answer is almost certainly no. The setup does not qualify. The map says do not enter. The referee enforces the decision. Your shield is never tested because you are not in the trade. 30 minutes later, the spike reverses sharply. The people who jumped in are selling at a loss. But you are just watching. Your capital is safe. Wow, this is boring compared to what most people picture when they think about trading. And that boringness, that deliberate, disciplined, systematic boringness, is precisely the point. The most successful trading is often the least exciting trading. Excitement in this business is usually the enemy of profit. Part 6. The realistic roadmap. I want to be very honest with you about what this journey actually looks like. Because unrealistic expectations will make you quit when reality does not match the fantasy. The 3M framework is not a shortcut. It is a professional-grade survival system that, applied consistently over time, gives you a real and sustainable edge. But the word time is doing a lot of work in that sentence. In the first 90 days, you are in execution mode. Your entire focus is on following your map perfectly, keeping your shield up, and developing your referee. You are not focused on returns. You might break even. You will probably see some small losses as you build the discipline to execute consistently. This is completely normal. These losses are tuition. The cost of building a skill, the same way a medical student's time during residency is an investment in their future career, not a waste. Traders who quit during this phase, and many do, quit because they expected quick profits and instead got a learning curve. From months 4 through 6, something starts to shift. The discipline of following your system begins to compound. You have enough trade data to see your system's real performance, its actual win rate, its average win-to-loss ratio, its maximum drawdown. You are no longer operating on faith alone. You have evidence. Small, consistent growth starts to emerge, perhaps 5 to 10% over this period. Not because you found a better system, but because you have been consistently applying a system with a real edge. But by year 2, if you have stayed the course, protected your shield, honored your map, trained your referee, you are in a completely different position from the majority of people who started trading around the same time as you. Many of them are gone. Some are on their 3rd or 4th account, but you are still here. You have a proven track record. You have genuine confidence, not the fake confidence of someone who got lucky early, but the real confidence of someone who has tested a system in real markets and seen it perform. And now, carefully and strategically, you can consider scaling up, not by abandoning your rules, by operating within those same rules with larger capital. Part 7. Your 3M audit. Do this today. I want to give you something practical to walk away with. Something you can do right now, not eventually when you feel ready. Do a 3M audit, 3 sections, 1 for each M. You'd get a piece of paper and answer honestly. For your shield, what percentage of your account are you currently risking on a single trade? If the honest answer is more than 2%, your first action item is to reduce your position sizes before doing anything else. Do you have a daily loss limit? Is it written down and genuinely non-negotiable? Have you recently added to a losing position or moved a stop loss to avoid taking a loss? If yes, your shield has been compromised. Thumb for your map. Do you have a written trading checklist? Not a mental one, a physical written document, listing specific objective criteria that must be met before you enter a trade? If not, writing that checklist is your most urgent action item before your next trading session. For every trade you currently have open, do you know the exact price at which you are wrong and will exit? If not, define that level right now. For your referee, look at your last 10 trades. Were any driven by FOMO? By the need to recover a loss? By overconfidence after a win streak? Be brutally honest. Are you keeping a trading journal that includes not just your entry and exit prices, but your emotional state and reasoning at the time? If not, start one today. Even a simple note per trade. What was I thinking and feeling when I entered this? Will reveal your patterns faster than almost anything else. Your 3M audit does not need more than 30 minutes. But those 30 minutes, applied honestly, it will give you a clearer picture of where you actually stand than hours of watching more chart videos or searching for a better indicator. Part 8. The mindset shift that changes everything. I want to close with the most important mental shift any trader can make, because it cuts against almost everything popular trading culture tells you. Your goal is not to get rich quickly. Your goal is to not blow up. This is not pessimism. It is not low ambition. It is the most strategically correct framing for your trading career. Because here is the truth. If you survive long enough, if you protect your capital through the inevitable difficult periods, continue to learn and refine and compound, the wealth follows. It does not come from one brilliant trade. It does not come from hitting it big on a single position. It comes from showing up every day, executing your system, protecting your capital, and letting the mathematics of compound growth work in your favor over a long enough time horizon. The traders who get rich slowly in this business are the ones who last. The ones promising to triple their account in 6 months? Most of them are gone in 8. The ones who are quietly, consistently, systematically growing their account, protecting their capital ferociously, following their system religiously, managing their psychology professionally. In 5 years, those are the traders that other people are trying to learn from. You are here, which tells me you are serious about trading in a way that most people are not. Most people just watch a few videos, fund an account, and start clicking buttons. The fact that you are thinking about structure, systems, and psychology puts you ahead of the vast majority before you have even made your first trade under a structured framework. But knowing about the 3M system is not the same as using it. While understanding the shield is not the same as keeping it up. Being aware of the psychological traps is not the same as having a referee strong enough to catch you before you fall into them. The gap between knowing and doing is where most traders live permanently, and it is a very expensive neighborhood. So your commitment coming out of this video is to close that gap. Pick up your shield, draw your map, wake up your referee, do the audit, write the checklist, start the journal. You make your stop losses non-negotiable. Make your position sizing a rule, not a suggestion. Show up tomorrow and do it again. And the day after that. Trading is not a lottery. For the trader who brings structure, discipline, and genuine psychological awareness, it is a business. And like any good business, it rewards those who build strong systems and manage their risks professionally. It punishes those who operate on hope, ego, and gut instinct. Survival first, profit later, shield up, map out, a referee watching. Welcome to the 10%. It is a quieter neighborhood than most people expect. But the view from here is worth every bit of the climb. That is everything for today on Mind Over Markets. If this gave you something real to work with, hit the like button. It helps this channel reach more people who genuinely need this. Drop a comment below and tell me, which of the 3Ms is your weakest right now? The shield, the map, or the referee? I read every comment, and your answer shapes what we cover next. Subscribe if you have not already. Everything on this channel is built around giving you what actually works in real markets. Nothing fluffy, nothing generic. I will see you in the next video. Stay disciplined, shield up, map out, referee watching.